So did the Bureau of Labor Statistics just cancel recession for Americans? Well, I'm going to go into the new PPI report, what it means for investors, what it means for you, and how it will affect the stock market. I'm Austin. Let's get into it. So first off, the Bureau of Labor Statistics just released their PPI report as of January 18th. And the PPI report is the Producer Price Index report. It is different than the CPI report, the Consumer Price Index report. So imagine this. You have your consumers and you have your producers. So what does this mean? It means we have buyers and we have sellers. The PPI report is your seller's report, and the CPI report is your consumer's report. So the PPI report measures how much everything's being sold for, and that's the report that we just got data from today, the Producing Price Index report. And the PPI report is a great report for the CPI. I know this is a lot of PIs, but the Consumer Price Index, that is what the Fed makes monetary policy off of. So if we look at the PPI report, it can show us what might happen with the CPI report. And so why is this important? Well, the Fed uses the CPI for their monetary policy, and if we can know and predict what might be happening on the CPI report, this is very helpful to us. So I'm going to go into what the Producer Price Index has shown us in December. Okay, let's go over to the Excel sheet and see what the actual numbers are right away. We want a bad report, and let me explain what that means. A bad report means that the Fed's policy is doing really well, and that means that we can potentially get out of a recession quicker or potentially miss the recession completely. So if we have a bad report or worse than expected, that is a very good sign for the U.S. economy. So let's take a look at the actual numbers and see what we got. So I want you to look at the forecast side. This is what analysts were forecasting and surveyed about what would happen during this report. And if we look at what actually happened, we see a great story. This is a good news. So the PPI month over month, that means compared to last month, we are down by 0.5%, which is huge because we were expecting to be down by 0.1%. And this is, a 5x difference almost compared to what we were forecasting. And previously we were up 0.2. So now that we're down 0.5%, this is huge news and probably the biggest, and that's why it's in green here. So the PPI year over year is down to 6.2%. That's compared to last year. That's not compared to the month over. So this one, I think it's easiest to interpret the month over month data. And we were expecting a forecast of 6.8. So we even demolished that one by being way less than that. And then previously we were at 7.3%. So the retail sales, core over month, and this is, like I said, this is demand, this is prices from the consumer, or the producer, sorry. So the forecast, we forecasted 0.4% to the downside, and we actually got 1.1%. This is huge. Like, we just blew out forecasts at a huge level. So back to me. Okay, we saw a terrible report. That is awful news if you're thinking about just the economy in general. But big picture, this is great news because that means Fed has decisions to make. And if they're going to continue their monetary policy, or are they going to do the pivot? And the pivot could be huge. So let's look at their actual chart. So the Producer Price Index, final demand declined by 0.5% in December. That's huge. That is huge. Like I said earlier, I kind of highlighted some of the important key factors here beforehand. Like I said, we're down 0.5% in December, and we expected to only be down by 0.1%. And the bigger the number to the downside, the way better we are. In contrast, this is the bad news. Final demand rose by 0.1%. So we don't want to see any price increases, as that means the Fed has to keep increasing rates. But this really isn't that bad because it's still lower than everything else year over year. So if we take 0.1% times 12 months, we only get 1.2% year over year. So, and really this isn't that bad of a news. So if we come down to the charts, in black, we have final demand, which is kind of, you just think of it as an average between the blue line, which is final demand goods, and the red line, which is final demand services. And we want to look here at the end where in December, look how big of a drop off that is, especially in final goods, which is, prices for goods and whatnot. That's huge, and that's great news. And then it comes over to the year over year chart where we also see a huge drop compared to, like, look how minuscule these drops are. And then we get, last 2 months, that's a very significant drop. Look, from blue line to blue line, big drop. Good news, big drop. So prices for final demands moved down by 1.6 in December, the largest decrease only 1.8% in July. This is huge news. This is great news. That means the Fed's policy is working. everything is going to plan. Leading the decline is energy prices are down 7.9%. Now, taking out food and energy prices, it's only down 0.2%, so that's not the best sign in the world, but food prices and energy prices are both very important. They do make up the biggest part of the price index. So let's look at the services that actually went up in price, which is, I guess you could be considered a bad thing. Airline services have gone up, inpatient care has gone up, and you can kind of think of that as there's also staffing issues with basically the whole medical field right now, to where they're having to pay more just to get workers in there. So that's naturally going to increase the prices of their goods a little bit. So keeping that in mind. Professional and commercial equipment wholesaling also moved higher. That's interesting. I don't exactly know why. And then the last thing here at the bottom that I have noted is gross rents for retail properties. This also went up, but we also got to consider that real estate prices lag way behind, and they're probably like 6 months behind of these actual prices for goods in immediate demand. So I think that those prices are going to fall drastically over the time. So that's not really a huge deal. And it really means that inflation is going better than we even see on the charts. So I want to bring it back. What does this mean for the economy and for the U.S. in general? Well, it means that the Fed has some huge decisions to make. If they see that prices are going in their favor and that policy is working, naturally you'd want to see that pivot, or they start reducing their interest rate increases. We just got an interest rate reduction recently. Right now, the Fed fund rate, or what every interest rate is based off of, is at 4.5%. And experts from the Fed and other Fed members had said that they expect rates to go between 5 and 5.25%. But they probably weren't expecting to have this good of data presented to them by these reports. And this is showing that we don't really need to keep increasing rates. And this is where the pivot comes into play. And the pivot is when the Fed cuts to a neutral rate, or they stop increasing rates, or they even cut rates. And that's going to be the decision that the Fed has to make, or Jerome Powell pretty soon. Now, what's interesting is the rhetoric from the Fed has been increasingly gloom, and they've said that positive rallies from market and whatnot will not influence what their monetary policy. So they're saying if the stock market does good, or certain labor markets do good, that they're going to keep cranking down on policy and making it worse. So they didn't really say anything if the inflation is better than expected, or deflation at this point even. So I think it's going to be interesting to see what they see at the next meeting, but all signs show that they could totally start decreasing rates, or at least make it neutral to where they're not increasing rates. It would feel like a bad idea to increase rates, because if they keep increasing rates, they could put us into a recession. So it's important that they act very quickly on this new data that's coming out. It'll be interesting to see what the CPI data says. Now, looking over at the overall stock market, it is kind of interesting to see that it is down today by 1.1% currently at 1 o'clock Eastern time. It looked like the Fed report came out around this time. So to the average investor, this would be considered a bullish sign, or that the Fed is doing well and rates could start to pivot and change. So it is interesting to see that the market is down. And this could just be big banks, having their own mind. Market makers can move the market how they want, basically. So it's a pretty strong red candle. So I'd expect the SPY to start heading down for a little bit. It'll be interesting to see if we get below this mark, where we could be heading for more downside, or maybe we consolidate here for a little bit and we start changing direction. Same thing with NASDAQ. They usually look about the same. We'll see some turbulence there as well. So it'll be interesting to see how the market is doing, but based off of this, you'd think you'd see it up, and it's actually down. So I appreciate if you subscribe. This is just my 2 cents. I read the reports, give it to you, hopefully make a little bit more sense. Have a good one.